happy to have Richard Cordray, the Director of the Consumer Financial Protection Bureau at the 2013 NCRC conference. Mr. Cordray has the distinction of being the first person to hold the role as Director of CFPB. He previously served as head of the Bureau's Enforcement Division, and also his first official field hearing was held in my hometown, Birmingham, Alabama. Now, I don't know if that makes us good or bad, because we might be known as the poster child for payday lending, but somehow I think that the director's visit has helped us to put an ordinance in place that limits the number of payday loan establishments in our city. So we should give him an applause just for that. And we also know that under his exceptional leadership, the CFPB has emerged as a strong protector for consumers, from their strong implementation of Dodd-Frank to ensuring that consumers aren't abused by financial institutions, to the agency's enforcement of actions against credit card companies like Capital One for their deceptive practices. I thought I could have kind of something on that. All right, there we go. They had a tremendous year in 2012, and we know that they're going to continue that extraordinary work. So prior to his service at the CFPB, he served as Attorney General for the state of Ohio, where he recovered more than $2 billion for Ohio's retirees, their investors, business owners. He's actually argued 7 cases before the U.S. Supreme Court, including by special appointment by both the Clinton and Bush Justice Departments. He's established himself as a tireless public servant and a defender of the public interest. And for these reasons and more, we, the NCRC, awarded him with the Henry B. Gonzalez Award in 2010 for his outstanding public service. And so we're pleased to have him here, and so help me welcome the Director of the CFPB, Richard Cordray.
Thank you, Bob. I could feel your distress as John was up here speaking about I was afraid he might refer to the internet, so we would have to give him the hook. But if you'll catch the subtle difference, John told you he's over 50. I'm slightly over 50. And back in our day, Tweet was part of the song Rockin' Robin. Remember little Michael Jackson used to sing this? Now it has a much more respectable pedigree. So thank you all of you for inviting me here to be with you today. Because of what you do every day, fighting to improve the lives of the nation's most vulnerable and underserved consumers, you are my personal heroes. And you set an important example for everyone at the Consumer Financial Protection Bureau. John and the board were asking me before coming out here for the breakfast what they can be doing to help us do our work. And what I said was, you can just keep doing what you already do, which is advocating, speaking up, and working for the people who need our help the most in this economy, the people who every day are trying to navigate the markets for consumer credit and need someone standing on their side, and that can be NCRC or it could be the CFPB. It doesn't matter to them, they just need someone standing on their side to look out for them and see that they're treated fairly. And if you'll keep doing that, we'll keep doing that, and we'll keep working together. So fair and equal access to credit is ingrained in both the Consumer Bureau's mission and your own mission. All of us in this room know and have seen the price people pay, often unwittingly, when they're victims of discriminatory practices. When someone is unlawfully denied a loan or overcharged for a loan to go to school, buy a home, or start a small business, our nation's commitment to equality shrinks and the gap for opportunity yawns a little wider. The fact of the matter is that the economic marketplace can be quite hostile to those in poverty or those whom society marginalizes for any reason. In today's economy, almost 2/3 of our households of color are liquid asset poor, meaning they have little or no savings to fall back on if they have to face a financial emergency. While nearly all Americans saw drops in their household wealth during the financial crisis, African Americans and Hispanics experienced the steepest drop. Access to credit, including small business lending, it's no wonder that communities of color are struggling to rebound in the wake of the financial crisis. This nation was founded on the principle that if you work hard and conduct yourself responsibly, you can get ahead in life. But when you cannot access credit, it can be nearly impossible to move forward. You cannot find ways to qualify for the basic means of self-improvement. At the National Community Reinvestment Coalition, we know you work day in and day out to propel working families forward despite these obstacles. Likewise, at the Consumer Bureau, we're fierce advocates for a consumer financial marketplace that allows people to pursue a path to opportunity. We're working to ensure that path is not disrupted by deceptive marketing or products that land consumers in a debt trap. We have a new role to play to help consumers avoid dead ends of discrimination. We want to do what we can to enable Americans to live out the fundamental principle of working hard and getting ahead. Leading up to the financial crisis, the consumer financial marketplace was characterized by many irresponsible lending practices. You saw it face to face in your communities. Too many borrowers were set up to fail with mortgages they could not afford to pay back. The ensuing collapse of the housing market had broad consequences, devastating businesses and causing jobs to disappear across every economic sector and in communities all through this country. This nation has a tremendous need to restore confidence and reliability to the mortgage market, which, as you know, is the single largest market for consumer finance. So Congress directed us to take action, and we have delivered. On time and under budget, as they might say of the occasional construction project. In January, we released our ability to repay rule, also known as the qualified mortgage rule. The concept of this common sense regulation is simple enough. Lenders must take care to make sure that borrowers will actually be able to pay back their loans. Put differently, consumers should only be offered mortgages they can actually afford. It's a strange world. It's a strange world indeed in which such a rule would even be necessary. But we all know from harsh lessons learned that the mortgage market prior to the financial crisis failed this minimal measure of basic responsible lending. Gone now are the no-doc loans. Gone are the so-called ninja loans. Under our new rules, gone are loans deceptively underwritten only over the introductory teaser rate, and much more. For the most part, those loans are not being made in the current market because the easy money from securitization has dried up. Some might say that's the genius of the market at work, and more regulation is not necessary. But the kind of extreme disequilibrium that resulted from inadequate oversight in a market that was only partially regulated is nothing to brag about. And it hurt millions of innocent people caught up in a disaster they could not understand or control, which should have been avoided. So we want to be certain that when the mortgage market recovers, as it surely will, we will never see these shoddy practices ever again. Another task that Congress placed before us was to write new mortgage servicing rules to protect consumers from deficient practices that have plagued this industry for some time. And again, we've all been face to face with it. These practices have resulted in profound consumer harm, and they brought us countless foreclosures that could have been and should have been avoided. Although Congress only required the Consumer Bureau to write certain specified rules in this area, we undertook to do more because many of us have seen firsthand the kind of misery that has been visited upon our communities. We saw wrong, and we wanted to right it as much as we could do so. When we came out with our original proposal, however, you put your hands on our shoulders and urged us to consider further refinements to our approach, in particular to address the harms of dual tracking more extensively. And we paid attention to your input by taking further action to restrict dual tracking and improve the rules in other ways. Importantly, the new servicing rules will cover both banks and non-banks for the first time ever. I remember that was a source of tremendous frustration. That was a source of tremendous frustration to me when I was serving as Ohio Treasurer and Ohio Attorney General. And these rules are backed by strong powers that Congress gave us to engage in supervision and enforcement, and we will and are doing so. We also wrote new rules addressing loan originator compensation and high-cost loans. Our changes to the HOPA rules in particular include expanding the legal protections for high-cost loans to purchase money loans and home equity lines of credit. On appraisals and other valuations, we provided greater transparency by making it much easier for a consumer to understand the value of the house being purchased. Copies of this important information must be provided free of charge to the consumer before closing. With all of these new rules, the Bureau is intent upon helping to bring more clarity and stability to the mortgage market. Consumers need strong protections to regain confidence and trust in that market. And lenders need to move beyond the uncertainty and fear that has led to a severe tightening of credit. The pendulum had swung too far. We believe our mortgage rules will help to improve access to credit for all borrowers while creating a more secure market. In our quest to fulfill our mission of fair and transparent markets, we're working to expand access to credit not only in the mortgage market, but across other consumer financial markets as well. When I spoke to you last year, I announced that the Consumer Bureau was giving fair notice on fair lending and that we would continue to apply the disparate impact doctrine wherever appropriate. We cannot afford to tolerate practices, intentional or not, that unlawfully price out or exclude whole segments of the population from the credit markets. Yesterday, we took another step to hold lenders accountable for potentially discriminatory actions that can cause considerable consumer harm. Here our focus is on potentially discriminatory conduct in the auto lending market. We released a bulletin advising lenders that offer indirect financing of auto loans that they can be held responsible and will be held responsible for complying with the fair lending laws. When consumers set out to buy a car, they're often unaware of what their financing options are. They may think that everyone, like them, is offered the same interest rate, that it comes off the shelf, and they do not realize that rates may be marked up. Indeed, markup occurs, as you know, in a substantial number of auto finance transactions. This markup is often applied after the lender has already quoted the dealer an interest rate that considers factors like creditworthiness and collateral. Our experience indicates that there is a significant risk that this discretion may result in pricing disparities on the basis of race, national origin, and potentially other prohibited bases under the law. Consumers can easily comparison shop for the price of the car, but less so for the financing. If an interest rate is quoted, consumers cannot easily ascertain whether that quote accurately depicts their position in the loan market. Dealers play an essential role for car buyers nationwide. They provide value and they deserve fair compensation for their work. But lenders are responsible for ensuring that the compensation system they are using does not result in unlawful discrimination. When lenders have policies that provide incentives to charge higher interest rates, it can lead to unequal discriminatory access to credit. We saw similar issues in the mortgage market with yield spread premiums. Discretionary markup policies create a significant risk of pricing disparities, and research indicates that such policies may result in African American and Hispanic borrowers paying more for auto loans than other customers. We're also concerned that similar risks may exist for pricing disparities based on other prohibited bases under federal fair lending laws. Such discrimination may not be consciously intended, but for consumers who are disadvantaged by these policies, the result is the same. Every consumer, regardless of race, gender, national origin, or other characteristics protected by federal law, should have equal access to credit and loan pricing that is free from unlawful discrimination. People deserve the chance to finance a car purchase at a fair price. Dr. Martin Luther King Jr. once said, "The time is always right to do what is right." At the Consumer Bureau, we're working to promote economic justice, and we seek to uphold the fundamental dignity and self-respect of every consumer. We've come a long way in less than 2 years. John, I've heard you say that data drives the movement of social justice, and we believe that too. We're a data-driven agency, and we try to take our bearings from the facts as we can best make them out, from our sweeping new mortgage rules to our efforts to promote fair lending. By this approach, we're making real progress to improve the financial marketplace and smooth the path to opportunity for consumers. All of us want And I think it's true that all of us want to put consumers in a position where they can make good choices for themselves, choices that enhance their lives and empower them to succeed. You are our strong allies in these efforts. We're grateful that we have colleagues like you who are so deeply dedicated to our shared mission. Keep your hand on our shoulder and push us to move ahead. Thank you.